You know that feeling when you check your savings account and realize you've been doing everything they told you to do, but somehow you're still not getting ahead? Yeah, that's not an accident. Right now, something is happening in the financial markets that only occurs once every 50 years. And I'm not talking about some conspiracy theory or get-rich-quick scheme. I'm talking about a measurable, historical pattern that's reshaping how wealth gets built and destroyed in this country. Most people won't even notice it's happening until it's too late. But if you understand what's going on right now, the next 5 years could completely change your financial trajectory. I spent most of my time breaking down how money actually works, not how we're told it works. And what I'm seeing right now is something I haven't seen in my lifetime. Neither of you, because the last time this happened was 1974. Here's the thing. When most people think about building wealth, they think about working harder, saving more, maybe investing in their 401k. And look, none of that is wrong, but what they don't teach you, what they conveniently leave out of every financial literacy course and every advice column, is that the rules of money change, not gradually, not predictably, but in these rare 50-year cycles that completely rewrite who wins and who loses. Let me show you what I mean with actual numbers, because this gets interesting fast. In 1974, the average American worker could buy a house for about 3 times their annual salary. Let's say you made $30,000, you could buy a decent home for $90,000. By 1984, that same ratio had shifted to 4 times annual salary. By 1994, it was 5 times. Today, in most major cities, you're looking at 8 to 10 times annual salary, in some places 12. The game changed, the math changed, but the advice stayed exactly the same. Now look, most people hear that and think it's just about housing prices going up, but that's not what's actually happening. What's happening is something way more fundamental. The relationship between assets and income is resetting, and it happens in these long generational waves that most people miss because they're too close to see it. The Federal Reserve published a study last year that showed something remarkable. They tracked wealth accumulation across different age groups over the past 50 years. What they found was that people who entered their prime earning years during certain periods built wealth at rates 5 to 7 times higher than people who entered during other periods. Same education levels, same work ethic, wildly different outcomes. Why? Because they caught the wave. Here's where it gets uncomfortable. If you're between 25 and 45 right now, you're standing at one of those decision points. The setup is happening whether you see it or not. And the scary part? The people who benefit most from these shifts are never the ones working the hardest. They're the ones who understand what's changing. Most people don't realize that wealth isn't built linearly. It's built in bursts. You can save diligently for 20 years and accumulate, let's say, $200,000. That's real money. That's discipline. But someone who understands the cycles can turn $50,000 into $500,000 in 5 years, not through luck, but through positioning. They're not smarter, they're not luckier, they just see the pattern. So what's the pattern right now? We're in the middle of what economists call a monetary regime change. That sounds abstract, but here's what it actually means. For the past 40 years, we've been in a declining interest rate environment. When you bought a house in 1985 with a 13% mortgage, that sucked, but over the next 30 years, rates fell and fell and fell. That created an entire generation of wealth built on asset appreciation. Your house went up, your stocks went up, your 401k went up, not because you were brilliant, but because you were in the right environment. That environment just ended. We've hit the bottom of that 40-year cycle, and now we're reversing. Interest rates are structurally higher, inflation is structurally stickier. The easy money isn't easy anymore. And this is the part that separates people who understand wealth from people who just follow advice. When the regime changes, the strategies that worked stop working. The people who keep doing what they've always done get left behind. You might be thinking, okay, but what does that actually mean for me? What am I supposed to do differently? This is where it gets interesting because the answer isn't what most financial gurus will tell you. They'll tell you to budget harder, cut your lattes, max out your Roth IRA. All fine, all helpful, but none of that addresses the actual problem, which is that you're optimizing for a game that's already over. Let me give you a real example. Let's say you're 30 years old with $50,000 saved. Solid work. Now, the traditional advice would be to put that into a diversified portfolio, let it compound at 7% annually, and in 30 years, you'll have close to $400,000. That math is correct, but here's what they don't tell you. In a high inflation, high interest rate environment, that $400,000 might have the purchasing power of what $200,000 has today. You did everything right. You still lost. The people who win the next cycle aren't the ones saving the most. They're the ones who understand that in regime changes, you have to change your strategy. You have to own different kinds of assets. You have to think about cash flow differently. You have to stop optimizing for growth and start optimizing for resilience. Vanguard did a study on this exact phenomenon. They looked at portfolio performance across different monetary environments, and what they found was shocking. The standard 60-40 portfolio, stocks and bonds, that's been the gold standard for decades, it gets absolutely crushed during regime changes. We're talking negative real returns for years at a time. But certain other strategies, things like hard assets, inflation-protected securities, even just holding cash strategically, they thrive. Now look, I'm not telling you to panic and liquidate everything. That's not the point. The point is that financial education in this country is fundamentally broken because it teaches tactics without teaching context. They teach you how to save, but not when to save. They teach you how to invest, but not what to invest in when the rules change. Most people are walking around with a playbook from 1985, wondering why it's not working in 2025. And the tragic part is they blame themselves. They think they're not disciplined enough, not smart enough, not committed enough. But the truth is way simpler. They're playing by rules that don't exist anymore. Here's the shift that needs to happen in your head. Stop thinking about money as something you accumulate through discipline alone. Start thinking about it as something you position for in cycles. The 50-year setup isn't about working harder. It's about recognizing that the macro environment just tilted, and the people who adjust first get the asymmetric rewards. You want to know what the smart money is doing right now? They're not panicking, they're not sitting in cash waiting for a crash, they're repositioning. They're moving out of long-duration assets that got crushed when rates went up. They're moving into things that generate income in high-rate environments. They're building optionality instead of chasing certainty. And here's the thing that frustrates me about most financial content out there. Nobody wants to tell you this because it's not sexy. It doesn't fit in a TikTok. It requires you to think beyond next quarter. But the people who build generational wealth, they're not doing it by finding the next hot stock or the next crypto moonshot. They're doing it by understanding the macro tide and swimming with it instead of against it. The last time we had a regime change like this was 1974. Inflation was spiking, interest rates were rising, the stock market was tanking. Everyone thought the world was ending. And you know what happened? The people who understood what was happening, who repositioned into hard assets, into energy, into inflation hedges, they built fortunes over the next decade. Meanwhile, the people who kept doing what worked in the 60s got obliterated. This is that moment again. Not the same exact circumstances, obviously, but the same type of structural shift. And most people are going to miss it because they're too busy following outdated advice. So here's what you actually need to understand. This isn't about timing the market. This isn't about predicting the next crash. This is about recognizing that we've entered a different financial era, and the strategies that got you here won't get you there. You need to start thinking about income, not just appreciation. You need to start thinking about protection, not just growth. You need to start asking yourself, if rates stay high for the next decade, if inflation stays sticky, if asset prices stay volatile, what kind of portfolio survives that? What kind of mindset survives that? Because here's the reality. The next 5 years are going to separate people into two groups. The people who saw the shift and adjusted, and the people who kept their heads down and hoped things would go back to normal. Things aren't going back to normal. Normal just changed. And look, I get it. This is uncomfortable. It's way easier to believe that if you just keep doing what you're doing, keep maxing out your 401k, keep saving 10%, eventually you'll get there. But eventually is a long time when the rules changed 5 years ago and you're still playing the old game. The 50-year setup is happening right now. You can't stop it, you can't ignore it, but you can position for it. And the people who do, the people who understand that wealth is built in cycles, not straight lines, those are the people who are going to look back in 10 years and realize they caught the wave. Everyone else is going to wonder what happened.